All right, I'd like to talk a little bit about the actual trade I just had and review my thinking and the risk management. Okay, so this is YM. This is Dow Jones Industrial Futures, basically a 10-minute time frame here. For my slightly bit longer time frame, I look at 60 just to get a sense of the general lay of the land, where we are, and do my fibs, do my volume profile, all the things I do to make a decision. And I also like to look at the range bars. All right, but that's like a 2-hour time frame. Now, so what I have here is an entry to sell short here, which I'll cancel this and just quickly review the trade. So I went in short originally right here, and my default automatic stop is 85 ticks, which of course is way too rich. So I immediately tighten it up to 25 ticks or so, right in this area. And then quickly added 4 more lots to a slightly bit winning trade. At this point it was up a few ticks, and I threw another 4 lots at. I then immediately realized that that would violate my risk parameters. Now my risk parameters are about $400 per trade, which when Apex talks about a $250,000 account with a $6,500 circuit breaker, in my mind it's really more like a $7,500 account or a $10,000 account at the most. Just for the sake of the argument, call it a 10K account. Keep it simple. So 10K account where you draw down 6,500, you're out, regardless of how many lots you can trade. To me, it's irrelevant. Now, with 5 lots on the go and my risk being at 25 ticks per lot, I was going to be risking quite a bit more than my predefined risk parameter. And the trade did start to work, and I trailed the stop very quickly to an almost a break-even, and then shortly after, it looked to me like the buyers started to come in. I could see initially the wick was forming, and then again and again. So we had the buyers coming in, so I got my 8 or 10 ticks out on 4 lots, and then trailed the stop on the last one, and of course got stopped out right here. And then that's what happened. So I was flat at this point. And you can clearly see that, the whole thing is just going nowhere. It's trading sideways, which gives me a really good opportunity to review the risk model. So what does it mean that I am running a, let's say, whatever it is I'm calling it. Now, so this is a little spreadsheet I created, and what we have here are our average daily targets, our average distribution of winners and losing days. This top layer here is assuming 10 trades per day. This is assuming 5 trades per day. This is our risk, $400. This is our percentage risk, is 4%. That's assuming it's a $10,000 account with a $6,500 circuit breaker. And our target is $460. So now, historically, traditionally, in the day trading environment, I rarely can get much more than 1.2 of my risk into the reward. I usually get a little bit better than my risk. So let's say if my average initial risk was 400 per trade, then my typical reward would be 460. That's all about. That's pretty much all I get. However, my win rate is typically better than 58%, so I dumped it down to about 58%. Now here what we have is worst monthly drawdown. That's the worst case per month in this particular shuffle of the hand. And this is average monthly drawdown is 3.8%. Now, when you look at the actual daily wins and losses, assuming 10 trades per day, here I have day 1, I made 300, whatever I made, then I lost a little bit of money, And if I'm trading 5 trades per day, you can clearly see that I'm down, I'm down, I'm down, I'm down, I'm down. So what's really interesting is in this particular distribution of outcomes, the very same trade strategy at 5 trades per day generated a whole bunch of losing days, where 10 trades per day did really, really well. Here at the end of 10 days sojourn, I would have made $7,500. And at the end of 5 days, I would have ended up netting $2,000, which is still pretty good at the end of 5 days. Now, all I have to do is click recalculate. And now here below are monthly targets. This is what an average could be made. This is with compounding, obviously. Now, if I recalculate in this particular case, now this equity curve represents a year's worth of trading, an entire year's, and this here represents the monthly targets. So looking good so far, and that's running 4% risk at 58%, a little bit better than 1-to-1. So it's working. Now, despite all that, you can see some really big losing days, no doubt about it. $1,000 in a hole here, losing. This was 1, 2, 3 losing days in a row, losing $560 per day, and still ended up making $3,500 at the end of the 8 days of trading. This was a killer day, really bad. I lost $1,400, lost $2,200. Here I lost a whole bunch of money. Still at the end of 10 days ended up in the green, barely, and at the end of 5 days ended up in the green for $2,000. Now, the overall a year's worth of trading would have resulted in a very, very nice equity curve, but that's kind of irrelevant because what I want to see is what is the chance of me actually blowing up altogether. And here what we have is worst case drawdown per month. So this number is 35%. So it's in this case, for me, let's say if it was a $10,000 account, in this case, $3,500 drawdown per month, I'm still in the game. 31%. 39%. I'm still in the game. 34%. Okay. So I haven't blown up once. 35% seems to be the worst case drawdown. And let's just click. Let's find a really bad one. Here's a good bad one. Day 3 lost 500, 500, $2,000. Lost a lot of money here. So how much would I be down? $1,000, $3,000, $4,000, $5,000, almost the entire pot, almost $6,500. Then finally saved the day a little bit. Ended up losing $900 after 8 days of trading, or 10 days of trading. 8 days of trading. So that's not so bad. I mean, there was a bit of a couple of good days, a couple of bad days. The strategy works. The system long-term works. This is the expected monthly income based on this set of distributions. Obviously, once I build up a bit of equity and I can trade heavier, I can start making $20,000 a month, but not right away because otherwise I get blown out. And at the end of 5 days, so I think it's false thinking to think that I can go in and make $15,000 in 3 days or 1 day of trading. That's pure gambling. And I think it's really unfair to encourage a gambler to buy accounts to just gamble. And because that kind of behavior would never hold up long term. Unless you're risking 10-15%, and then you definitely won't be around long term. So here's an example of losing $1,300 in 5 days. 5 days of trading, lost $500. 5 trades per day, 8 days. So that's a week and a half of trading and down $1,300, but it's not the end of the world. So that is how the whole thing rolls with a 4% risk, with a 58% win rate. and with a return to risk ratio of 1.15, which happened to be my historic long-term live trading pattern. And the only thing that's different is I normally can do 65% or more, or even 75%. 58% is dumbed down, but I wanted to do it that way. So even though theoretical long-term equity curve looks amazing for a year's worth of trading, but this is what we get from day to day with this kind of trading. So it's very important, and after 8 days of trading, it could be down a bunch. So it's very important to keep things in perspective. We could still end up with a typical worst case drawdown per 100 trades is monthly, is 38%. That's a lot. But in the context of the Apex, the so-called $250,000 Apex account, which allows me the circuit breaker of 6,500, I'd still be in the game. Okay. But definitely if I tried to roll with $5,000 risk per trade or $2,000 risk per trade, hoping to make the $15,000 mark to pass in one day, that's pure gambling. And I actually take offense to that, to even suggest to people to do that. I mean, the gamblers don't need to be encouraged. They're already gamblers. This is what they want to do, is gamble. They want to make big money quickly and easily, and they are gamblers. But systematic traders need to think of it as a system and work the system in a way that has a positive expectancy, long-term positive expectancy, which means, in my mind, not trading more than 4% risk per trade, even though occasionally people can trade 30% risk per trade and make millions in a market they're very sure of. Not day trading markets, long-term trading markets, position trading markets, holding trades for 6 to 8 months. That kind of a trade, yes, have your 30% risk, but not day trading. So that's my last rant of the day here.